This is InvestTalk. Independent thinking, shared success.
Hi, guys. Great show. I just wondered what you think of the PIMCO Dynamic Income Fund as a dividend. Thank you.
All right, looking at PDI is the symbol, PIMCO Dynamic Income ETF. And PIMCO, generally, it's the largest bond fund manager in the world. So obviously they're doing something right. Now, the worry here is that like a lot of these, this is what we call a closed-end fund. It's not an ETF. It's a closed-end fund. And they have leverage, about 30% leverage here. And it has a high distribution rate, about 14%. So that sounds great until you realize that leverage can create problems. So if I go look at a chart and I zoom back out, what you can see is this peaked out all the way back in early 2020, $33 per share. And it fell during COVID all the way down to $19 per share, rallied all the way back to 29, and now it's back to 19. And why is that? It's because of duration risk. It owns bonds that have some duration. And if you look at the total return, okay, over the last 10 years, you're talking about 9.4% annually, which is pretty good. 5 years is 8.9, pretty good for a bond fund. But it's very, very high risk. You're going to get those big drawdowns, and that price decline is natural. There are dividends included in there. There is some duration here, 2.6 effective duration, and they're taking credit risks. So the average credit rating is B, which is junk. Okay. So it's leverage with not a lot of duration. So that's the positive here is, I might have said that before, that duration might be an issue. This is not really 2.6 is the duration. Not a lot of years there. So it's low risk on that side, but it's high risk on the credit quality side. So if you do get the credit markets coming undone again at some point, you have a major recession, this is going to lose a lot rather quickly because of that credit risk it's taking. So understand the risk there. Having this as a part of your portfolio, the high risk bond slice of your portfolio, I have no problem with. It's historically pretty good performing, and a lot of the credit risk, what I would worry most about is where is it taking that credit risk? Okay, is it related to private equity, for example? I'd have to dig into this a little bit more. And if it is, I'd be very, very worried about it because I think private equity is a lot of problems. If it's more along the lines of traditional corporates, then I would be okay with it. And it looks like here it's 25% government, 28% corporate, 23% securitized, about 13% cash and cash equivalents. So overall, I think it's okay. The securitized is probably the biggest worry, about 23%. That would probably be where the CLO is collateralized loan obligations are probably housed. But this is one of those ones where it's very complicated. You have to kind of unpack its holdings in a big, big way. But understand it's very high risk. And anytime you're getting that type of yield, that is what you are taking. You're taking high risk. So if you're okay with high risk, then I don't mind it as a small slice of a bond portfolio.
Hey guys, I wanted to get your thoughts on Simply Good Foods Company, ticker symbol SMPL. It's near its 52-week low, just trying to find some potential deals in what feels like a bit of a frothy market. The company owns quality brands like Atkins and Quest, which both seem to be doing well and continue to expand their product offerings. It reports earnings tomorrow, so I wouldn't pick up any shares until afterward. I just wanted to get your guys' thoughts on this one and if it may be a good pickup long term. Thanks for what you do.
We're looking at Simply Foods Company, SMPL, and it has been struggling as of late, that's for sure. Relative strength is at 16, but it's not at multi-year lows or anything. It's just at the lows of the range it's been in since 2021, between about $29 per share. Let's call it 30, and a high end around the low 40s. So it's at 32 now. Earnings this year is supposed to be $1.94, $2.06 next year. Although those estimates are coming down. No dividend is probably the biggest issue on that front. But they have a good balance sheet, very little net debt. Their debt to equity ratio is only 0.16. Free cash flow is $178 million on a $3 billion market cap. That's decent, 5-6% free cash flow yield. Return on equity is 8%, 8.4, which is where it's been in for a while, which is a good business, but certainly not amazing. Now, what they do is they provide low carbohydrate, high protein bars, shakes, and other products under the Atkins and Quest brands. So that's the issue I see is Ozempic, right? If that's the new way that people lose weight, then what do you need a low carb diet for? Now, I'm a much bigger fan personally. I've done a ketogenic diet, a low carb diet. I didn't use their products, but it is a brand that's been around a long time. They were kind of the pioneers around ketogenic diets, and I think they work. I think they're great. High protein, high fat, low carb. I personally have once again utilized that type of diet to cut weight dramatically. Actually, quick story: I did a body fat challenge with some friends some years back, and in 13 weeks I went from 15% body fat to 10, just doing keto, working out, playing basketball, etc. So it was I recommend it to everybody who's trying to lose weight. I think it's a much healthier way to lose weight than Ozempic, but for some people, obviously that's one way to do it. I actually kind of like this because I think at some point there will be a reversion to actual food and this type of healthier way to lose weight. And it's a good business. It's not amazing. It's probably one of the top of my list of companies that I would buy. But if you're trying to fade the Ozempic trend, the GLP-1 trend, this would be a good way to do that. Once again, probably not my favorite way to deploy my capital in this market, but it's fine. It's a solid business. I like that they have a good balance sheet, etc. Now let's keep things moving and play another fresh listener question now.
Hello, InvestTalk. This is Yannick from Denmark. I have a question about corporate bonds. The bulk of my free money that I have invested is in corporate bonds, USD corporate bonds, and 1 to 3 year term corporate bonds. This is like almost 100% bonds. In my pensions account, I have some stocks. But regarding my bonds, they've dropped a bit. I was wondering if I should sell them, buy stocks instead, because I recently heard that the American stocks are actually undervalued now because everyone is afraid that the tariffs is going to cause a crack in the investment world. When everyone's afraid, you should be bullish. So I was wondering if you think I should sell my corporate bonds and go stocks again. Would very much like to hear your opinion. Thank you. Bye.
Well, I would argue now after this rally, the market is offsides on the impact of tariffs, and that you're timing wise, you're not. It's not a great time to be moving money from, say, corporate bonds into equities broadly. Now, there are certainly 100% there are opportunities out there. So if you have specific companies, then that may make more sense. But just broad based, okay, timing wise, not the best time, I think, to get into U.S. equities. Corporate bonds, I'm not sure why they dropped recently. If I pull up like an LQD, a chart of LQD, which is the investment grade bond ETF, it's rallied fairly nicely, and you're short duration, so that's good. I don't see credit spreads widening out, so I'm not sure why they've dropped as of late. But I wouldn't be. This isn't to me a time to be trading out of equities and finding great bargains out of corporate bonds and finding great bargains in equities. I just don't see that as good timing at the current time. Now let's pivot over and talk a bit about, I like this immigration story. This is from the Dallas Fed, and they looked at a period between 1955 and 2019. And what they said was that U.S. GDP growth typically increased for the 2 years in response to unexpected increase in net unauthorized immigration and then gradually reverts to its mean. So what it's saying is you have a boost in economic growth, economic output, and slight deflation or disinflation, which makes sense, right? Because as the workforce grows, economic output goes up. That's a plant. It's a product of just more labor supply. When you put in more capital, you put in more plant and equipment, you put in more labor, you get economic output. That's simple, basic economics. So that shouldn't shock anyone. And then inflation comes down because, once again, more labor supply means less upward pressure on wages. Now, that could be the reason why a lot of people want less immigration, because of the long-term impact that has on pay for workers. But what they're just looking at is, what does it do in the short term over the first couple of years? And their base case, and they looked at what does this mean for future economic output under a Trump administration that clearly has drastically reduced, if not eliminated, immigration. And now they are obviously looking to deport a large number of undocumented workers. So what kind of economic impact will that have in the short term? That's what they're looking at. Now, once again, this isn't me saying this is good policy or bad policy. It's just simply the facts backed up by historical data. Now, what the Dallas Fed was looked at the net unauthorized immigration statistics and keeping them in place as of the spring of 2025. So March, April, May time period. And what they see is annual GDP growth is going to be about 0.81% lower this year and 0.49% lower next year. Okay. Now the question is, will they ramp up the deportations? If they do, you're talking about farm laborers, roofers, meat packers, etc. They're calling this high interior deportation. So not just stopping people from coming into the country, but actually actively finding them that are undocumented and deporting them. And they assume that this will rise to about 437,500 per year. And that would cut economic growth by 0.83% this year and 0.84% next year. Okay, so nearly 1%. And you add on top of that, if people self-deport, they've talked about, hey, we'll pay for your flights to go back to your home country. If you self-deport between now and middle of next year, that would shave off about 1.01% this year and 0.45% next year. And under mass interior deportation, so this is not high interior deportation, you're talking about mass, meaning high for them is 437,000 people. And under mass interior deportation, they're saying it would be over the next 2 years, 1 million annually. Okay, so over double what the quote unquote high interior deportation rate is. That would cut growth by about 0.89% this year and 1.5% next year as well. So that's the raw economic impact, most likely, obviously, these are models, but the model is based on previous data, previous economic activity, etc. And the bigger question, I think, is, will it be magnified? Because it's, if you say you run a hotel and you are employing some undocumented workers to work in the kitchen, clean rooms, etc. And, years ago, maybe one or two get deported, you can find replacements and keep operating. But let's say ICE comes in and deports the vast majority of your staff. Now you may not be able to actually even run your operation, right? And then that could snowball itself to laying off front desk people and those that work in events and other parts of the hotel, for example. So I think that's the big question: is what other, if it's in mass, what type of magnified impact will that have? And that is difficult to quantify because we haven't had that type of data, because any change in immigration has been minor, not major. And so it's interesting to follow that, but we'll see how that evolves and which way it goes. Is it going to be high interior deportation? How much self-deport? And how many will there be mass deportations as well? Now, every day, we receive questions from the comments section of our InvestTalk YouTube channel. And here's one that came in earlier from Salinas: is, what are your thoughts on NEE? I believe their focus on solar and wind energy is going to be a strength in the future, but I'm a little concerned about the location of their services. Florida is notorious for natural disasters. Is that something to consider? I think the simple answer is yes. You answered your own question. And I actually don't think that the investment in that clean energy or traditional clean energy of solar and wind, historically, those payback periods are very, very long. And they take on the high upfront costs and creates a lot of debt. And the good thing is this is a regulated utility. So a lot of cases they could pass along that high cost of debt to the citizens of Florida. That's where Next Energy operate out of Florida. And so I don't think it's going to be a bankruptcy thing or anything like that. I think they'll be able to lobby the regulators to help them with any potential issues. But if I'm betting on a utility company out there, this is very low on, I won't say very low. This is lower on my list because of that focus on renewables, frankly. We actually looked recently, reassessed our utility sector rankings, and Next Era was not near the top of the list. So I think there are much better opportunities out there. I rather focus on companies that have nuclear, as the main focus point on today's show is about. I rather focus on companies that have that capacity, that are building out that capacity, et cetera. Whereas right now, approximately 30% of Next Era's energy growth comes from its renewable energy development. And like you said, when you have hurricane potential issues and the damage that could be done to solar and wind farms, et cetera, and the high upfront costs, I think there's a lot of risk there on that front. So I would put this middle of the pack to lower on the totem pole when it comes to utility companies that I would invest in. Thanks for the comments. Let's pivot over to a live call. Eric in Phoenix looking at CVCO, which is Cavco Industries. What are you liking about this name?
I was just thinking that it was in a different part of the housing market, something that seems more affordable housing. And then their financials seem to be good. They're buying their own shares, and They don't have very much debt. And then they had like vertical integration of like providing mortgages for their own product and insurance options.
Yeah, got it.
I like that.
Yeah, I think this is a very interesting name. I will say that. What they do is they make factory-built homes. So modular homes, mobile homes, vacation cabins, etc. And in a world where affordability is challenged across the country, this is certainly homeowners are looking to these solutions, and they've done very well. Pre-COVID, 2019, they made $7.40. This year, they're supposed to make $23.99, up 11% from last year. Supposed to go up about 13% next year in earnings as well. And I like what you were talking about, where they're buying back shares consistently. They're using their cash flow. Like you said, no debt, really net cash on its balance sheet. $157 million in free cash flow on about $3 billion enterprise value. In 2021, they had 9.2 million shares outstanding. Now they're down to about 8 million shares outstanding. So consistently using that cash flow to buy back shares. I like that. Enterprise value to EBITDA is around 14. Now that is on the higher end of its range over the past 5 years. So I wouldn't say it's cheap. My biggest worry with this is the chart. And it's now in a downtrend. It broke its uptrend, broke the 200-day moving average back in May, late May. And it's had a recent bounce, but still below the 50, the 100, and the 200-day moving average. And so it's in a downtrend. It's in a clear downtrend right now. But I do like the business overall. If you look at profitability, return equity is 16%. And that's great with very little debt. Now, I don't think they're going to earn as much they did in 2022 or 2021 when return equity peaked at 32%. But even if you go pre-COVID, their return equity was always in the mid to high teens, which is a good business. So I like that. Okay, so what I would say is keep this on the watch list and watch for the technicals to firm up a little bit. I don't like that downtrend. There could be an issue with tariffs. I have to dig into it, right? How much of their of the homes are they importing? Or is it just components of the homes? Where is it? What does their supply chain look like? I think that would be a question I would want answered on top of the chart firming up. So do a little more digging, do a little more research, be patient on it because it's not like it's running away from you. It's like I said, in a downtrend, and so keep it on the sidelines for now. Thanks for the call. I like these. I like that he's looking at smaller companies that have good balance sheets. That's crucial in this environment where over the medium term, long term, rates are probably going higher. Short term, yeah, rates could drop. You could go through a Fed easing cycle. But due to our fiscal situation, most likely rates are headed higher. And so that's going to flow into the ability for companies that are highly levered to finance themselves. That's going to hit their bottom line because their interest costs are going to go up. And it also probably keep the housing market from really breaking out the upside and brings continued affordability challenges. And this is a company that can address that for some people. So I like the name. I like the chart. I'm Justin Klein. This completes another InvestTalk program. And if today's show made you think about what's going on in your financial life, whether that's retirement planning, whether that's just strategy within your portfolio to prepare for an inflationary environment, for higher interest rate environments, whatever concerns you might have, I encourage you to schedule a no-cost portfolio review with me or Luke. All you have to do is head over to investtalk.com, click on the portfolio review button, and fill that out, and we'll get you on the calendar. I did a couple of those today. Now, we thank you for listening to this podcast and radio show, and we encourage you to tell your friends and family about our free podcast downloads at any time. iTunes, Spotify, or Google Play, and be sure to rate and review on iTunes as well. Independent thinking, shared success. It's InvestTalk.